Chapter 11, Risk Management. Section 1, Position Sizing. Position sizing is simply deciding how big a trade should be before you enter it. The goal is not to predict the market perfectly, but to make sure one losing trade only costs an amount your account can realistically handle and recover from. The logic starts with risk, not with how much you want to buy or sell. First, choose the maximum dollar loss you're willing to accept. Then divide that by the risk per share, unit, or contract to find a position size that stays inside your limit. The most common approach is fixed fractional sizing, where you risk the same percentage of your current account on every trade. That means position sizes naturally get larger as the account grows and smaller after losses, which helps keep risk in proportion over time. Fixed ratio sizing works differently because size increases in steps as profits build, instead of adjusting smoothly with every change in equity. It can be useful, but for many beginners, it's harder to manage consistently than a simple fixed percentage method. A practical process keeps sizing repeatable, even when market conditions change. Measure your current equity, choose your risk percentage, calculate the maximum dollar loss, work out the risk to your stop, round the size down, and then do a quick check for liquidity, margin, and overlapping exposure. A stock example makes an important distinction clear. The amount you spend on a position is not the same as the amount you're risking. In a $50,000 account risking 1%, a trade might use nearly $15,000 of capital, while the planned loss is still only about $500 because the stop is close. In futures, you have one extra step because the stop distance has to be converted into dollars using the contract multiplier. That calculation can completely change what is tradable, which is why a micro contract may fit your risk plan while the standard contract is simply too large. The nice thing is that the core idea doesn't change from one market to another. Whether you're trading stocks, Forex, futures, or crypto, you still begin with the loss you can afford, then translate the stop distance into per unit risk and size, the trade from there. Even if the math looks correct, a position can still be a bad choice in the real world. Large orders can slip in thin markets, and several trades that look separate on paper may actually pile up the same exposure, so sometimes the right move is to cut size. Most position sizing mistakes come from misunderstanding what actually creates risk, using fixed share counts, confusing position value with trade risk, forgetting contract multipliers, changing stops without recalculating, or ignoring correlation and liquidity can all make a trade much larger than it seems.